Okay. All right. So recording, I think. Okay. All right. So I wanted to do the account equation. And because we're going to learn bookkeeping in this class, I want to add normal balances. All right. So you may or may not have seen the accounting equation before. Who's seen this before? Okay, so this is the basic accounting equation. Of course, in order to have a business, everybody knows that why we study accounting, right? Accounting is the literal language of business. Can't talk about a business without using accounting terms. So that's why we're learning accounting terms. So whether you're an accounting major or whether you're a business major, you need to understand some accounting terms, right? Okay, assets. What's the definition? Everything the business owns that has what? Future economic value. That's what an asset is. What's economic value? It can be bought and sold in the economy. Somebody would be willing to pay you money for it as economic value. Okay, so your old 1995 Chevy is probably not going to have a lot of economic value, right? Nobody wants it, right? Me, I like my 1990. Okay, anyway, so that's what an asset is. In order to make money, we have to have assets, right? A company has to spend some money in order to make money. Okay, we have to have assets. So that's everything the company owns. Okay, we had to get the money from somewhere, right? A business starts with nada, nothing. Okay, just an idea that's in the brains of some entrepreneur. So the first thing we got to do is get some money, right? Two ways to finance assets. What are they? Two ways to finance assets. Come on.
Liability and equity.
Debt and equity. Okay, good. Debt, we can borrow the money, or equity. So we can solicit other owners. We can bring it out of our own pocket, savings account, whatever. We can steal it, right? Wherever you want to get money that you don't have to pay back, that's owner's equity. Okay, money that we have to pay back, that's a liability. So which one's better to finance with debt or equities? You may know. It depends on your motives. Okay, so if you're a brand new company and you're just an idea at this point, and you go to a bank and I've decided I want to start a business making nuclear reactors. So I go to my local bank and say, I'd like to borrow $10 million. And the bank's going to say, what? Right? Okay. They're not going to loan you any money. Okay. And it happens a lot with small businesses. You have no credit. You have no reliability. The bank has no way of even imagining that you can pay that money back. So most small businesses cannot borrow from a commercial bank. Okay. You might be able to borrow from a loan shark, right? But of course, if you don't pay that back, they break your legs, right? So you don't want to do that necessarily, okay, unless you're pretty sure you can pay that back, all right? So it's difficult to borrow if you're a brand new company because you have no history. You have no reason for a bank to believe that you can pay that money back. And if you go to a bank, you can't blame the bank, right? If they tell you no in borrowing money. Why? They have regulators as well, right? So in the United States, most of our banks are insured by FDIC. Does anybody know about this? We got a little bit of familiarity with banking. Federal Deposit Insurance Corporation. So it's a company that an entity, I should say, that insures federal banks against loss. So because the FDIC is insuring them against loss, they have a right to come in to make sure that they're not losing the FDIC's money, right? The bank's money. They have to protect the bank against loss, okay? So they have a right to come in and audit. So the FDIC will come in and check the bank's records. If they see a $10 million loan for a reactor, they're going to want to see a lot of information that says you made a good loan, okay? So they're going to check the loan officers, the board, everybody that made the decision to loan that money to make sure that it was a good decision. Okay. So it's not a bank problem. It's it's not the people in the bank being the problem, it is the system, okay? So they cannot make a loan if it's high risk. They're not allowed to, okay? Does that make sense? So you can't blame the bank. It's just the way things are. All right. So if you're trying to start a brand new business, maybe you don't have enough money personally. If you do, fine, great. Okay. Owner's equity, right? So say I need $100,000 in cash to start this business. I can either get it by borrowing it, or I can get it by either myself or maybe family members. Maybe you got a rich uncle, especially if he's got one foot in the grave, right? Okay. So you can get the money from a family member, maybe, or maybe a friend. You may have somebody that it would be willing to go into business with you. So you start a partnership, right? Instead of just a sole proprietorship. Or if you want to be a corporation, you get a whole bunch of people to help you to finance your business. Okay. So this is an equation, right? Assets equals. So we can either borrow it, some of it, all of it, or we can contribute it, some of it, or all of it. So if we are a brand new company, more than likely, we're not going to get to borrow anything. So everything's going to have to be contributed. Okay. Does that make sense? Okay. So what are liabilities then? Everything the company owes to outsiders, somebody other than the owners. These would be insiders. Okay. What's owner's equity? That's the insiders. So if the money came from the insiders, we attribute that to owner's equity. Okay. Makes sense? So business have to have assets, and two ways they can get them. All right. So everything the company owns is equal to everything it owes, because it started with nothing, right? The money came from somewhere, and we can tell where that came from if we understand accounting. All right. So owner's equity has two parts: capital. And we also call this contributed capital, because it's been contributed by the owners, voluntarily contributed by the owners. So if it's a sole proprietorship, then we have different types of businesses. What's a sole proprietorship? Sole. You own by yourself. Good. Sole owner, one owner. So one person decides, I'm going to hang out a shingle and I'm going to be a business. In the United States, you can do that so far, right? So you can just hang out a shingle. Suddenly I'm a business. I'm a sole proprietorship. Okay. If I need to solicit somebody else, because maybe I don't have enough money or I don't have enough expertise, I solicit somebody else to come into business with me, then I become a what? Good. Partnership. Okay, so that just means that there's more than one person that has contributed their monies and has started this business. If I'm worried about getting sued, what do I need to be? An LLC or a corporation. Good. So what's an LLC? What does it stand for? Limited liability company. So even if I am a single individual, no partner, just myself, I can elect to be treated as an LLC, limited liability Kentucky company. Okay, I was going to say in Kentucky, it's easy to do. All you have to do is sign up and become an LLC. So you just register your business as an LLC, and suddenly you're an LLC. And what that means is that your liability for this company is limited. So if the company gets sued, they can't come back after your personal assets. All right. So say the company has $10,000 in it. We hurt someone. They sue us. They sue the company for $100,000. It's only got $10,000. So where's the rest of the money going to come from? The owners, right? They got to ante up. So if you don't have liability protection, you're a sole proprietorship or a partnership, you're going to have to ante up that shortfall. Okay. Your personal assets are at risk if you're a sole proprietorship or a partnership. If you chose to be an LLC, and keep your nose clean, right? You have to make sure that you treat the business like an LLC. I took a class from an attorney once on these different types of businesses, and that was one thing that he really emphasized. And it makes sense that in order to, in the courts, be treated as an LLC, because this is going to be a lawsuit. is what's going to force somebody to have to pay additional monies that the company doesn't have. Okay. So in the court of law, if you treated the business like a limited liability company, you kept your personal assets separate from the company's assets, more than likely you're going to be protected. If you commingled and you treated it just like a personal checkbook, you did not separate the business from your personal assets, you may not win in a court of law. Okay, so it's not just signing up to be called an LLC and using that name. You have to make sure you treat it like a business. Okay, so it can't be your personal checkbook. And so I always tell my clients that is make sure you keep it separate. Make sure that you have a separate bank account for your personal things, and then you use the business just for business things. Anytime you have an invoice, signage, sign on the side of a truck, make sure you use that LLC name. Everybody that you're doing business with needs to understand that they are doing business with an LLC or a corporation. Same thing for a corporation. That way they are aware that you are not personally liable for anything that they sue for. Okay, you're not personally liable because you have limited liability protection, but you have to make sure that everybody, the consumer, needs to be aware that they are dealing with a limited liability entity, whether it's a corporation or an LLC. Okay, does that make sense? So both have the LLC and the corporation have liability protection, limited liability to the owners. So it's limited to just what money we have in the company. So whatever we've contributed, that's gone. Okay, if the company doesn't have enough money to pay for the debt, then whatever we've contributed or whatever the company has earned, that's gone. Okay, but they can't come after my house. They can't come after my personal bank account. Okay, so that's why you got to keep it separate. Okay, make sense? Another thing about a corporation, not only does it have limited liability protection, but it gives us an opportunity to have more owners, right? So all these stocks that I like to buy on the stock market, those are corporations. So I can buy little bitty pieces of this company, and I'm an owner, right? Okay. So if a company needs to raise $10 million, not going to get it from a bank, right? Not too many banks can loan you $10 million. Okay. Not too many banks, even if they could, would, right? Because it's too much concentrated liability. But you might get 10 million people to give you $1, right? Okay. So if you're a corporation, you can sell little bitty pieces of the company and all these people become owners. They don't own enough to be too influential in the operation of your business. So it's a pretty good deal, right? So they're owners, but they really can't have any say so in your business. Okay. So that's why a lot of small companies, they do an IPO. Who can tell me what an IPO is? So you're a sole proprietorship or you're a partnership and suddenly you want to go public because you need lots and lots of money. Initial public offering. So that's a brand new corporation or a corporation that is brand new to the stock market. Okay. So they are suddenly selling their stock publicly. Okay. And of course, they're usually high risk businesses. Some investors specialize in buying IPOs because they like that high risk. Because oftentimes you can buy into an IPO for a small amount of money, and then when they take off, you can make big money. But of course, it can also go in the other direction, right? You could lose everything that you invested. Okay. So everything that you invest in that company is at risk. If they go bankrupt, guess what? You got nothing. All right. So investing in the IPO, it can be risk or reward. Everything in the stock market can be risk to reward, right? So you can either go up or it can go down. And there's no guarantee, there's no insurance against that. Okay. All right. Anyway, so we can, and I like to call this contributed capital account capital because that kind of covers them all. Now, of course, if we're talking about a corporation, we would call this stockholders' equity. Okay. Not owner's equity, but stockholders' equity, because all the people that own little pieces of this company is called a stockholder. So we would actually call this account common stock. Okay. If it's a corporation, this would be common stock. If it's a sole proprietorship or a partnership, it's generally called capital, and it'll usually have the owner's name attached with that. So it might be Joe Smith Capital or Joe Smith and Aaron Smith Capital. Okay. So because it would identify whose money that is. Okay. All right. So I like to call it just capital. And that way it covers them all. So we know that capital is contributed capital, came out of the pocket of the owners. The other side, of course, once the business gets started, hopefully they make some money, right? So the other part of owner's equity is what we call retained earnings. Can anybody tell me the full definition of retained earnings? It's kind of long and nasty.
Money the business made that is paid.
Very good. Very good. Okay. All right. Money that the business has made that it's still retained, right? So I like to say the full definition is everything the company has earned for what period of time from the beginning of its life until now that it has not paid out as a dividend. That's why it's called retained or kept earnings. Okay. Does that make sense? So everything it's earned. So revenue minus expenses, right? So let's break that down. So what's revenue? What's the definition of revenue? You may know. Everything the company good earns is called revenue. Okay. What's expenses? What are expenses, I should say?
They could also be.
Exactly. The cost of earning that revenue, whatever it costs us to make that money. And you know, it costs money, right? It's going to cost money to make money. Okay. So revenue is what we earned. Expenses is what it cost us to make that money. So if I say revenue minus expenses, that's my profit, right? Okay. That's how much I got to keep. Okay. Next, dividends. What are dividends? Good. It's what the company pays out to stockholders. So whenever I solicit people to own this business with me, they're going to want a return on that money, right? Just like a bank. If I borrow money at the bank, what do they want to collect? Interest. Good. So if I borrow money at the bank, I got to pay that back. It's called principal plus interest. That's the money that the bank makes for loaning us that money, right? They earn interest. Well, if you buy or you sell stock in your business or you sell a ownership percentage in your sole proprietorship or partnership, those owners are going to want a return as well. And it's called a dividend. Okay. So liabilities, we incur interest. If we finance with owner's equity, we may incur dividends. But of course, that's a choice. Okay. So one reason that a company, we talked about the fact that a brand new company or a company that's in financial distress may not be able to borrow money because nobody's going to loan to them. But there may be an incentive to use owner's equity besides just the fact that we can't borrow money. Maybe we don't want to. Okay. So maybe we want to solicit owners. What's true about debt? If I go to the bank and borrow money, they're going to set me up a payment plan, right? And I got to make those payments as they come due. Owner's equity, not like that. When does a company have to declare a dividend? Never. Never. It's the company's choice. There's no legal requirement for them to pay a dividend. So they may never pay you a dividend. Do they want to? Yeah, because you want to keep your investors happy, right? You want to keep them buying your stock. So what happens if a company has a financial status, they're earning money, they're paying out a dividend, people want to buy that stock, right? And the stock market, what drives the stock price? Emotion, right? So if a company's making money, paying out a dividend, everybody wants to buy it. So everybody, have you learned supply and demand yet? So if you have a limited amount of supply of stock and everybody wants to buy it, what happens to the price? Goes up, right? So low supply, high demand increases price. And then the vice versa. If you have high supply, low demand, what happens to the price? That's what happens in the stock market. If the company's looking good and people want to buy it, the price is going to go up. Something bad happens, right? Everybody wants to sell that stock. The more people that want to sell that stock, it starts spiraling downward because everybody's selling. So I'm going to sell too, right? Well, that's foolish. Don't do that. So you look at the company. Sometimes it's just going down just because of emotion. So sometimes that's a good time to buy, not a good time to sell, right? Because what do we want to do in the stock market? Buy low, sell high. Okay, right? Okay. Anyway, so dividends are good. So if I want to keep my stockholders happy, I want to pay out a dividend, but only when I can financially do that. only when I don't need the money for something else, either some kind of project that I've got going on in the business or to pay off some debt. Maybe I want to pay off debt. And of course, that's good for stockholders, right? So if I own a company, I might rather the company pay off debt than pay a dividend, right? Just because that's going to be good for the success of the company long term. Okay. Of course, I'd like to have the dividend in my pocket as well. Right? Okay, so dividends, that's a return paid to the owners in appreciation of using their money to buy assets, right? Then I want to add a couple of other things. Gains and losses. Okay. So if I sell an asset, a long-term asset, what's long-term? More than 1 year, good. Okay, that's a long-term asset. So if I have a delivery truck that I no longer need, it's not something I sell every day, right? So maybe I'm selling shoes. Okay, so every day I'm selling shoes, right? Every time I sell a pair of shoes, it's what? Revenue. That's how I earn my money. I'm in the business of selling shoes. But if I have a delivery truck that I previously used to deliver shoes, that's a long-term asset, right? Also called a fixed asset. So this delivery truck, when I decide to sell it, if I sell it for more than what I have in it, I have a what? Gain. If I sell it for less than what I have in it, I have a loss. Good. Okay. So gains, that's the gains and losses, that's the selling of a long-term asset other than what I sell every day. Okay. What's the stuff called that's laying on the shelf that I sell every day? Inventory. Good. Somebody's awake. Okay. What's the definition of inventory? Everything the company owns that's available for sale in the ordinary course of business. That's the long definition of inventory. Okay. So my shoes that I have on the shelf, that's what I sell every day in the ordinary course of business. The delivery truck, I don't sell those every day. I'm selling it because I'm through with it. Okay. So therefore, when I sell the delivery truck, it's either a gain or a loss. If I sell shoes, it's revenue. Okay. Does that make sense? Isn't this fun? Okay. So that's the accounting equation. Now I want to go back and add something else. In order for us to record transactions, and that's what the primary thing we're learning in this class is how to record transactions, how to take things that happen in the business and record them in a journal in such a way that facilitates our being able to prepare financial statements. Okay. So in order to do that, we have to understand normal balances. Okay. You probably never heard these words before. You may have. So this may be brand new terminology to you, but you'll get it pretty quickly. It's all very logical. Okay. So when we're talking about assets, actually all of the accounts, we actually use a T account to represent a category or an account. Okay. So this is called a T account because it looks like a T, right? So in accounting, every account, every category has a title. So under assets, what's an asset that a company might have? What would an asset the company would own?
Cash.
Let's go with cash. Good. Yeah, building's good. Let's go with cash. All right. So that bank account, it's an asset, right? How do I know? Does it have future economic value? Absolutely. It's the most economically valuable thing we can have is cash, right? Okay. All right. So let's say we have cash. So under assets, we're going to have cash. Actually, let's list some others. What else? So buildings, equipment, inventory, right? These are all things that a company might own. Land. What about accounts receivable? What is that? Who can tell me what accounts receivable is? If you look at a balance sheet, you're going to see accounts receivable a lot.
Payments to be collected after a sale.
Very good. Payments to be collected after a sale. So when we do business with customers, sometimes they pay at the time of the sale, sometimes not. So we may allow them so many days to pay in sometime in the future. Okay. So anytime we sell something on account, okay, that's called accounts receivable. Those are accounts or customers that is receivable by the business. And you might think, well, I can't touch it, right? That's what do I own if I own accounts receivable? The right to collect that money. So yes, accounts receivable is an asset. Can I sell the accounts receivable? Actually, I can. I can go to a bank and sell my accounts and let the bank collect them. There's actually companies that will factor your accounts receivable. They will buy your open accounts and collect them for you for a fee. Neat. Okay. So accounts receivable, the money that's owed to the business is an asset. It does have future economic value, either in the fact that I can collect it or somebody else can collect it and make money off of it. Okay. Good. All right. So these are assets, all assets. All right. So assets have a normal balance of debit. Okay. And you're just going to need to remember that. The normal balance for an asset is debit. And what that means is that every account or category is like a bucket. Everything on the left-hand side of an asset increases. Okay? This is called the debit side. I actually have a little song sometimes I play, debit, left, credit, right? Okay, so everything on the left-hand side of the T account is a debit. Everything on the right-hand side is a credit. And of course, I wrote DR. Let me explain what that means. That is the shorthand for debit, but of course, there's no R in debit, right? So that comes from the time of the Inquisitions when the generals would go out to war and they started out, they would keep a debit register of all the assets that they received as spoilage from war. And they kept a credit register to show all the generals that earned those assets that they collected. Okay. So it was a debit register and a credit register. So that's why it's DR and CR are the shorthand for writing debit to credit. Okay. All right. So if I'm talking about an asset, debits increase an asset and credits decrease it. Okay. So I know this is foreign. This is called the normal balance. The normal balance for an asset is a debit. So if I want to increase an asset, so say I collected $1,000. So I'm going to put $1,000 on the left-hand side. That increases that asset. If I paid out $100 of that money, I'm going to put it on the right-hand side because that decreases an asset. Okay. Increases, decreases. Okay. Let me go further. Liabilities. So everything on the left-hand side, of course, the only thing over there is assets, right? Everything on the right-hand side is a credit. Liabilities are credit and owner's equity is credit. All right. So if I collect $1,000 from the owners, I'm going to increase assets by $1,000, right? Equal sign. And I'm going to increase liabilities by $1,000. Okay. Assets go up, owner's equity goes up, right? Because that's where the money came from. All right. So if I were to look at my owner's equity account, my capital account, that $1,000 would go over here. Okay. Increased assets. Actually, because the normal balance for liabilities is credit, this increases the capital account. Okay. So a capital account, because it is a credit balance, increases by credit and decreases by debit. So it's the opposite. Okay. Same thing if I borrowed money. So instead of getting $1,000 from the owner, if I borrowed $1,000, increase cash, $1,000, increase liabilities, $1,000. Okay. So if this is my liability account, so when I got the money, debit cash, credit the liability, and then when I pay it back, what am I going to do? So say I paid $100 on that debt. I'm going to decrease cash and decrease the liability, right? It's called double entry accounting. So anything that I do to the left-hand side, I got to do the same thing to the right-hand side. It has to stay in balance. It's an equation, all right? So if I write a check to pay for a debt, I'm going to decrease assets. Normal balance is debit, which means I have to credit the asset, and I have to decrease liability because the normal balance is credit. I have to debit the liability. Okay, does that make sense? And if I were to write that out in an equation, it would look like this. Okay, every equation has to balance. So I would debit the liability, credit cash when I make a payment. When I receive the money that I borrowed, I would debit cash and credit the liability. This increases cash and increases the money that I owe, right? Increases assets and increases liability. Does that make sense? Okay. And then when I'm paying the money back, I'm going to debit the liability, which decreases it because it has a normal credit balance. And I'm going to decrease cash because it has a normal debit balance. Okay, does that make sense? Starting to come together. All right. All right, so let's continue. So assets are debit. Everything on the left-hand side is a debit. Everything on the right-hand side is a credit. So if I borrow money, liability, that's a credit balance. Money comes from the owners, that's a credit balance. Owner's equity is a credit. So that means because capital increases owner's equity, it's also a credit. Because retained earnings increases owner's equity, right? If I'm earning money, that makes the owner's account higher or the owner's equity higher. So retained earnings is also a credit balance. Because revenue increases retained earnings and retained earnings is a credit, revenue must be a credit, right? Because expenses reduce retained earnings, it has a minus sign, it must be a what? A debit. What about dividends? It has a minus sign, must be a debit. What about gains? It has a plus. Credit, okay, because it increases owner's equity, so that's a credit. What about losses? Has a minus sign, so it must be a debit. Okay, starting to make sense? Okay, let's look at some other transactions now that we understand that. All right, so what happened in our business? All right, so first and foremost, so we decided to start a company. I got $10,000 in my savings account, going to transfer for that from my savings account and contribute it into my business. Okay, sole proprietorship. All right, so now I'm going to write a check, deposit it into the business. So the business has a cash account. So I'm going to increase cash because I transfer this money into the bank account. So I want to increase cash. Cash has a normal balance of debit because it's an asset. So I'm going to increase cash by $10,000, debit cash. Where'd the money come from? Came out of the owner's pocket. So I'm going to come down here to the capital account and increase owner's capital by $100,000. And that's a credit. Okay, so I'm in balance. Assets increased, owner's equity increased, right? Okay, so say, then what am I going to do? I decide to buy some equipment. I got to have some equipment for the business. So what am I going to buy it with? Cash, right? I've got $100,000 or $10,000. Let's say I need $1,000 worth of equipment. All right. So what kind of account is equipment? Asset, liability, owner's equities. Asset has future economic value, doesn't it? Okay. So equipment. So I'm going to write a check. So what happens to cash? Cash goes down. Equipment is also an asset. So equipment goes up $5,000. Okay. So I have an increase in assets and a decrease in assets. What happens to the other side? Nothing, right? So I can exchange one asset for another. So how would that look? So if I were to write it out, I'm going to increase equipment and decrease cash. So debit equipment, that increases it. Credit cash, because its normal balance is debit, that reduces cash. Does that make sense? Okay. What else? Let's see. Let's say I need to buy some supplies, okay, for my business. And maybe I have an account at the supply store. So I can go to the supply store and say, put that on my tab. Okay. So say I buy $100 worth of supplies. Okay. And I'm going to put them in the closet. What type of account is supplies? Asset, liability, owner's equity. Asset. Because I just bought them, right? Do they have future economic value? Yeah, okay, so maybe I bought a printer or some toner or some paper and pencils and, things that I'm gonna need in my business, right? Supplies, cleaning supplies, okay? Anything, something to work on the equipment, oil for the equipment, whatever, okay? So something that has value, future economic value. So another thing that companies own is supplies, okay? And as long as they're not used up, they still have future economic value. They have value, all right? So supplies is an asset. When they get used up, what do they become? Who remembers this from 270 class? Supply, any asset when it gets used up becomes what? An expense. I'd remember that. Anytime an asset gets used up, it becomes an expense, all right? Okay, so there's supplies. All right, so say now say I need to rent a building for my business, okay? So I'm gonna have to spend some more money, right? Anytime I spend money out of my cash account, its normal balance is debit. So I'm going to do what? Credit cash, right? Because I want cash to go down. So I'm going to credit cash, say $500. And I'm going to pay rent. What is rent to a business? Does it have future economic value? Just for the month that I paid for, right? But at the end of the month, it's what? When an asset gets used up, it becomes an expense. So in accounting, even though on the first of the month, it's still an asset because it has future economic value. But by the end of the month, it's gone, right? It has no future economic value. So because we usually prepare a financial statement either by the month, the quarter, or the year, generally, if we're paying rent by the month, we just call an expense when we pay for it. Does that make sense? Okay, because it's already used up by the time the month ends. All right. So when we pay this rent, we're going to debit rent expense because the normal balance for expense is what? Debit. So we've incurred more expenses than we did before. We spent some of our cash, so we debit rent expense and credit cash. It always has to balance. Every transaction, that's what these are, right? We're transacting business. We're exchanging resources outside the company. So anytime we transact business, there has to be at least one debit and at least one credit, and they must be equal. Now, I might have more than one debit. I might pay for utilities and supplies and rent all in the same check. It's possible. So I might have multiple debits and multiple credits, but there has to be at least one debit and at least one credit, and they must be equal. Does that make sense? Okay. All right, let's see. What's another thing that can happen in the business?
Prepaids.
Prepaids. Well, of course, supply is a prepaid. Okay. Another one, we need insurance, right? So not only do we want to make money, but we want to protect the money that we've made. Okay. So let's buy an insurance policy. Okay. So insurance is always a prepaid. Why? Insurance companies don't trust you to pay after the fact, right? So if I'm driving a vehicle for my business and I have an accident, I'm not going to be able to go back and buy a policy, right? Because I've already had an accident. That would be stupid on their part, right? So what we do is we buy an insurance policy that insures us against loss, but we always have to pay that up front. Insurance companies don't trust you to pay after the fact, right? Okay, so insurance is always prepaid, and prepaid means that it is an asset, but it's going to turn into an expense. Okay, it's a prepaid expense. It's an asset. It's never going to be sold. It's just going to turn into an expense. So that's called a prepaid expense. So when we buy this policy, it's going to be called prepaid insurance. Okay, and let's say that it cost us $1,200. What do we pay for it with? Cash. What's the normal balance for cash? Debit. So if I want to decrease cash, do I debit or credit? Credit. Good. Okay. And because prepaid insurance, does it have future economic value? Does that policy have future economic value? For the year, exactly. So if I wrap that truck around a tree, it's got future economic value, right? Because it's going to pay off that truck. It's going to pay for the liability. So it definitely has future economic value. Okay. All right. So prepaid insurance is an asset. Normal balance for asset is debit. So when I buy that policy, debit prepaid insurance, credit cash. Okay. All right. All right. So what about, okay, I earned some money. All right. So I'm a trucking company and did my first run and got paid. So let's say I got paid $1,000. What's the journal entry? What did I get paid in? Cash. What's the normal balance for cash? Debit. So I want to debit cash because I had more cash than I had before, right? So I'm going to debit cash. What am I going to credit? Remember, every transaction must have one debit, one credit, and they must equal. Okay, more specifically, when I earn money, what is it? Revenue. Good. Okay, so inside of revenue, revenue is a category. So inside of revenue, I'm going to have an account, a category that's more specific. So this, we'll call this what? Trucking revenue. Okay. Trucking revenue. And it's a credit, right? What's the normal balance for revenue? Credit. So anytime we earn more money, we want to credit revenue. Okay, so we debited cash because we received cash. Its normal balance is debit and credited revenue. We're in balance, right? It's not a coincidence. All right. All right. Let's say all right, let's say that part of that policy got used up. It's the end of the first month, and part of that insurance policy got used up. Anytime we use up an asset, it becomes an expense. So what's the normal balance for expense? It's a debit. Okay, so if I incurred more expense than I did before, I want to do what? Debit expense. An asset normal balance is debit. So if an asset's getting used up, what am I going to do? Debit or credit? Credit. Good. Okay, because I want the asset to go down. Okay, so if 100, so say it's a 12-month policy, right? And it costs us $1,200, so it gets used up to the tune of $100 per month, right? So let's say 1 month of that insurance policy got used up. So what's my journal entry going to be? Insurance expense, right? To keep it in its proper category, is $100 debit because the normal balance for expense is debit. And prepaid insurance, the asset account, is a credit because the asset went down. Okay, so if I were to put that on a T account, it might make more sense. So I looked at prepaid insurance. When I bought that policy, I debited it, right? So left-hand side of the T account, debit. And then every time I use up a month of that policy, I'm going to credit it and debit insurance expense. Okay, so insurance expense is going up, prepaid insurance is going down every time that 1 month lapses. Does that make sense? So it's easy for me to look at the prepaid insurance account to see how much is left, right? So at the end of 3 months, I can look at that, how much is left? $900, right? Okay, so I have a $900 balance left in this account. I know that it's an asset, so its normal balance is debit. So since I have a debit of $900, that policy must be worth $900. Okay, does that make sense? If I look at the cash account, okay, so let's see what happened first. I collected $10,000. We said that was a debit, okay, and then we started spending some of the monies. So we spent $1,000, we spent $500, we spent $100. So at any point in time, I can look at this account and say, how much money do I have?
8,400.
Yeah, okay. So I can look and say, I have, is that right? I can look at this account and I can see that I have $8,400 left in cash. So I have all of these this kind of narrative, right? All these things that happened, but because I have this coding system, right? It was invented by Louis Pacioli, by the way, in the 1400s. That's where accounting came from. He's my hero. Okay. He invented this system. Been the same ever since the 1400s. The system of debits and credits. And you see how great, how neat it is that I can look because I have this coding system for a transaction. I can look at this account and see how much money I have. I can look and see how much the insurance policy is worth. I can look and see how much I've spent for rent, how much I've spent for supplies, just by looking at these accounts. Yes, ma'am. I can. Good. Yes, good question. All right, so let's say that I needed some money and I decided to borrow. Okay, so I went to the bank. Bank makes you sign a note, right? So we know it's a liability, right? Anytime we borrow money, it's a liability. So let's say that I needed $10,000, went down to commercial bank, and because I've got some money in their bank, they're going to loan me $10,000 just because they know me and I have a reputation with the bank. So if I borrow money, so say I borrow $10,000, what's the journal entry? What did I receive? Cash. So debit, cash, or credit cash? Debit, because it's a normal balance of debit. So cash is a $10,000 debit. And because the bank gave me this money, but I owe it to them, right? So it's a liability. Normal balance for liability is what? Credit. Do I owe more than I did before? Yes. So I need to increase liabilities by credit. Not a coincidence, right? Debit, cash, credit to liability. So in this case, because now anything payable is a liability, right? Because it's something I owe. Everything I owe is a liability.
Where's the interest go into this?
Okay, we'll get there. Good question. Okay. All right. So when I borrow the money, debit cash, credit an account called notes payable. That makes sense? So I increased cash and I increased my liability. Notes payable. All right. Does that make sense? So debit's cash, $10,000. Credit to notes payable, $10,000. The next month, bank's going to want some money, right? Okay. So say that I need to pay them $1,000 principal and say I need to pay them $200 of interest. Okay. So I got to write a check to the bank for $1,200. Okay. What's the journal entry? Journal entry. Now, am I receiving cash or paying out cash?
Credit cash.
Credit cash. Good, because I'm paying out cash. Okay, so it's got to go down. Normal balance is debit, so that means I got to credit cash. Okay, good. All right. So, but what about liabilities? I gotta lower the liability. So I'm going to debit notes payable. Now, when I'm writing out a journal entry, the proper format is to list my debits first and then my credits. And I put my debits in the left-hand column and my credits in the right-hand column. So usually a journal looks like this, okay? A debit column on the left, debit, left, credit, right, debit, left, credit, right? Okay? So I'm going to debit notes payable. I said I'm going to pay them $1,000 plus interest, right? What is interest to a company? If I'm borrowing money, an expense. It's a cost to borrowing money, right? What's the normal balance for an expense? Debit, okay? So interest expense, debit, $200. Where did money come from? That makes sense? Isn't this fun? Yeah, okay. So if I look at my cash account, I'm going to credit it for $1,200. Cash went down. So if I were to look at that account now, I know exactly how much money I have left, right? If I looked at my liability account, I have now paid $1,000. I debited it for $1,000. So if I look at this, how much money do I owe? $9,000. Okay. What if I looked at my interest expense account? Looks like that, right?
So the interest expense is only account, not the notes payable.
Absolutely. Absolutely. Everything has its own category. So these, the elements of the account equation are simply big categories. They're groupings, okay? Within each grouping, we have different accounts, okay? So that we call these types of accounts. So under liabilities, we have notes payable. We also have payroll payable. We have rent payable. We have taxes payable. We have utilities payable. We have accounts payable. Anything that's payable is a liability, right? So now we could just have one big account that says liabilities, but that doesn't tell us anything, right? So the more we separate the accounts, the more information we gather. We can have one big account that's called assets, but that wouldn't teach us anything. We wouldn't know how much money we had, right? And we wouldn't know all the other assets, how much accounts receivable, how much equipment, how much insurance, okay? So the more we can break down a category, the better, because it gives us more information about the company, right? Okay? All right, so owner's equity, of course, capital, is either common stock or capital, depending on the type of company we have. Revenue, so we can look at our revenue account. So if we're Walmart, how do we make money? We buy crap and mark it up and sell it at a profit, right? So our revenue account is called sales. Okay, so every time we sell stuff, what's the normal balance for revenue? Credit, right? So every time we sell stuff, we're going to credit sales. If we collect it in money, we're going to do what? Debit cash. What if we didn't get paid? What is it?
A lot.
Nope, not yet. What if we haven't gotten paid yet? Very good. Okay. So if I'm a company and I sold something to somebody $1,000 for cash, I'm going to do what? Debit cash, credit sales. But what if am I going to get paid later? I'm going to debit what? Accounts receivable and credit sales. Does that make sense? What type of accounts receivable? It's an asset. I own the right to collect that money. So if I want to increase accounts receivable, it's a debit. Anytime I earn money, I'm going to credit a revenue account because its normal balance is credit. Okay. So now let's see if we can go in the other direction. What happened here? See if you can reverse engineer this just because you understand this language. What happened? We debited cash, you credited note payable. Think about this as a journal. Everything that happens in the business, we're writing it down in a journal, just like the journal that you write in every night. I said, I love you, and she didn't say it back. You write that in your journal, right? Exactly. So because you understand the language, you can read that entry in the journal, right? Okay. So what happened here? You received money, right? How you know that? Because you debited cash. Where did it come from? You borrowed it from somewhere, right? Of course, we're using a big category, so we don't know where you got it from, okay? But you borrowed it from somewhere. What happened here?
Yeah.
I paid on a debt, okay? How do I know that? I credited cash, so I know I paid out cash. What did I pay it out for? I reduced the liability by debit, so I must have paid the debt that I owed previously, right? Good. All right, what happened here?
You bought equipment,
I bought equipment with what?
cash.
Cash. What if I bought it and I didn't pay for it? So what if I bought it on account? So we said accounts receivable is when customers owe us money. What's accounts payable?
You owe money.
When we owe money to somebody else, okay? So I went to the equipment store and says, put that on my tab, okay? So I've received equipment, right? Equipment is an asset, right? So debit equipment. And then if I'm going to pay this later, I'm going to credit accounts payable, right? Does that make sense? Debit equipment, credit accounts payable. So if I were to go back 10 years later, being an accountant, I can read this journal and say, what happened there? I bought equipment and I didn't pay for it yet, right? I bought it on account. Does that make sense? So because we understand this language, we can go back and read these journals years later because the language hasn't changed since 1400s. Okay. So I could go back and read Louis Pacioli's journal and see what happened in that business, right? But if I'd written it in a narrative, he could have written all this stuff out. Business today, bought equipment for $1,000, going to pay that back later. But that doesn't facilitate our being able to make a financial statement. But because we have it coded in such a way that we can see what the balances are in each category, we can make a financial statement out of this. Is this cool? It's cool. Okay. Let's see what else happened. What happened here?
Yeah, but expense with cash.
I paid an expense. What type of expense? I paid the rent. Okay. What if I had paid a utility bill? It would have been utilities expense, right? Okay. Debit utilities expense, credit cash. What if I'd paid payroll? You had employees and you had to pay them. Debit payroll expense, credit cash. So you see how categories make a difference? We want to know how much it costs us for payroll, right? We want to know how much it costs us for utilities. We want to know how much it costs us for insurance. Why? Because this business needs to be able to compare itself to other businesses. Okay. If they're making money and I'm not, I want to know why, right? How am I going to know? Either my revenue must be too small or my expenses must be too big if I'm not making as much money as them. So I can drill down by looking at these categories and see how they're making more money than me, right? So the more categories we have, the better, right? But everything goes by category. All assets are debit, all liabilities are credit, all revenues credit, all expenses are debit. Okay, so we can still read the language. What happens here?
Paid off your insurance.
I bought, okay, because it's an asset, I bought an insurance policy for $1,200 in cash, right? So I can go back and read the journal because I understand the language. What happened here?
Received, something. Sales.
Do what? I sold $1,000 worth of stuff. I can tell because I credited sales, which is a revenue account. So I know I sold stuff. Did I get paid? Not yet. But because I increased accounts receivable, I'm hopefully going to get paid in the future, right? What about when I do get paid? What's the journal entry? What does it look like? So say customer pays me that $1,000. I'm going to do what? No, not revenue. I've already recorded the revenue. Right. So now I'm going to get paid. Good, because I got paid in cash. And what? And credit accounts receivable. Okay, does that make sense? So if I were to look at my accounts receivable account, when I sold it, what did I do? Debited accounts receivable, credited sales, right? So if I looked at my accounts receivable account, it would look like that. When I collected that money, I'm going to do what? Debit cash, credit accounts receivable. How much is owed to me now? See what the category does for us? We know how much is owed to us at any point in time because we understand the language. Sweet. And of course, if this is $100 million, same thing. We know how much money is owed to the business. Two sides.
Yeah, so it balances.
Always balances. Every transaction, what's a transaction? The exchange of resources. So anything this company does, so whether it's buying something, selling something, paying a debt, collecting money from the owners, paying the owners a dividend, everything is a transaction. If they're exchanging resources, what's a resource? An asset. If they're exchanging resources with any outside entity, that's a transaction. And we're going to record it in a journal in such a way so that we can produce a financial statement. So the next thing we'll learn after we've learned how to record the entries, we're going to produce an income statement, balance sheet, statement of retained earnings, and a statement of cash flows that's going to give us lots and lots of information about this business. Isn't it cool? All right. All right, I don't know how to stop.